It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Hello, folks. Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. My name's Mike Bernard. I am your host, as well as one of the certified financial planners on the show, along with my colleague, Kevin Korhorn, and special guest Ryan Fair.
Yep, we're in the fourth quarter, and it's time to ensure that you're employing the right tax strategies for 2017. You want to finish strong, and you don't want to end up paying more tax than you should, and you don't want to miss the tax planning opportunities. Some of those opportunities are done 12/31, and some go until 4/15. Some go to your tax filing deadline. So we are joined by a very special guest, CPA Ryan Fair, and he's going to help us talk tax strategy. He's going to help us talk the tax Trump plan and a whole lot more packed into this hour.
Tax Trump.
Say again, over?
The tax Trump plan? I like it. I like it. There you go.
Yes.
Got it.
Okay. Trump tax plan.
Got it.
Okay.
I've heard of that one.
All right, folks, as always, this is your show. We want to hear from you. There's always lots of questions surrounding taxes. I tell you, if we have time, we're going to hit a couple at the end of the program, although we've got a lot to talk about. So submit a question. You can do so in a couple ways. Give us a call. Send us a text, 574-222-2000. Reach us online, revamped website, wisemoneyradio.com. You can submit a question right there on the right, as well as catch up on previous episodes. Speaking of catching up on episodes, you can watch us right now on YouTube or catch things on Facebook and Twitter. All of that are at Wise Money Radio. Thanks for joining us. So, are you going to win? Are you going to lose? Are you going to break even on this GOP tax plan? We're going to talk about that coming up, but we're going to first hit some tax strategies. Before we do, Ryan, introduce yourself to everyone listening.
All right, thanks, Mike. Yeah, I'm excited to be back. It's been a while since I've been on the show, so thanks for having me, guys. So what do people need to know about me? Not much has changed since the last time I was on. Still married, same wife, Elin. We're going on a bunch of years now. And still have two amazing little girls most of the time. And Jenna's doing great in first grade right now. And Reese is actually in her first year of preschool. So she's learning lots. And I think her big sister has really helped her out, learn a lot. It's pretty amazing what they know at this age already. So, yeah, I've been at KFG for 16 years already, which is crazy. It's been a while. So, and stuff that I enjoy doing outside of work and outside of the family is, as I've mentioned before, I'm still an avid collector of old gas station and Studebaker stuff.
Oh, you're promoting right now.
I am.
That's shameless, Ryan.
I know. I offered discounts last time I was on your tax return preparation if you give me a good lead. But, yeah, Studebaker stuff and old gas station stuff.
And Ryan helps lead an amazing tax team. He's one of our CPAs. We've got, it's more than just Ryan. We've got a great tax team that helps folks. So glad to have you on. All right, there is about a month and a half left in the year 2017. And as Kevin already said, there are some tax strategies that expire at midnight, like Cinderella, and we want to point out some of the tax tips that either you need to be aware of before 12/31 or before April 15 or whatever. Okay, so we're going to break down our top 3 tax tips for you that you can employ right now. Ryan, kick us off.
All right, I'll kick it off. Mine's not very fancy. It's kind of boring in the big picture.
It's taxes.
Well, it's all taxes and boring. Peanut butter and jelly. Cookies and milk. Taxes and boring.
But the reason I'm sharing is because something that most Americans are failing to take advantage of, and that is just funding their good old retirement plans. So whether that's a retirement plan through work, so the common ones are 401k, 403b, simple IRA, or just their regular IRA, traditional and Roth. Stat that I was reading said 2/3 of Americans don't contribute to a retirement plan that's available through their employer.
You know, just a quick segue on that. In a couple weeks, we're going to be talking about. There's been some recent news and some research done on these auto enrollments into 401ks. We're going to be talking about in a couple weeks. Some of that you'd think that's good. Actually, some of it's not so good, folks, and we're going to talk about it. So Ryan's pointing to the reason why that's out there, and that not a lot of people are saving.
Yeah, it's crazy. Another stat was a third of Americans have no retirement savings. That's nuts. It just blows my mind every time I read stuff like that. So from a tax standpoint, or without even looking at the tax side, people, you got to start saving for retirement plan. It's gonna be here before you know it. Like I mentioned, my kids are already first grade, and I've been married, I said, for a bunch of years. Time flies. I'm going to be talking in retirement one of these days before I know it. So
it helps you on your taxes, though. So Ryan, one of the unique things about Ryan is he's a certified financial planner.
Yes.
Who's also a CPA.
Very unique.
So it's very unique, and it's a huge benefit to the folks that he gets to serve, that we get to serve, because he's talking about things that are helpful on your taxes, but also helpful just in your overall financial life.
Right.
So that's good. Good nudge.
So I would like to talk about it. Ryan's talking about funding and funding your retirement plan. For most folks, you're talking about pre-tax dollars there, and so that's helping you pay fewer taxes. If you earned $1 today and paid federal and state taxes, you might have 70 cents in your pocket to spend. If you leave that dollar on the conveyor belt and it drops into the retirement bucket, you've got $1 going to work for you. So the question is, would I rather have 70 cents in my pocket to spend today, or would I rather have $1 in my retirement plan? And you can go to YouTube and look at the marshmallow experiment and get all kinds of ideas about that. But that's not what I'm here to talk about. What I'd like to talk about is the HSA. And lots of folks, right now, there's a lot going on with healthcare and the questions about how does it work and what kind of health plan should I have, and I just got a 33% increase, et cetera, et cetera. I want to talk to you about the HSA. And a lot of times people say, if I say, well, what kind of health plan do you have? They say, well, I have an HSA. And I would just, as a point of clarification, I would tell you that what you likely have is a high deductible health plan.
That makes you eligible to contribute to a health savings account.
Correct. And then the health savings account, the HSA, is I can put money in pre-tax, and it comes right off the front page of my tax return. If I'm married couple, I can put in $67.50. If I'm 55 plus, I can put in an extra $1,000 or more. So this is where you want to be working very closely with your financial planner, and as we say, make sure they're certified. So work with your certified financial planner on this, but also work with your tax planner. And we'll ask folks, well, who does your tax planning? Well, they don't necessarily have anyone who does tax planning for them. They might have someone who does tax preparation. But I'd say between now and the end of the year, if you haven't met in the last couple months with your tax planner, get that meeting scheduled and look at what is available to you. Because if you can put that money in pre-tax, that comes right off the front page of your tax return, that reduces the amount of income you're paying taxes on. And that could be the difference between whether or not you get the child tax credit or not, whether you get a retirement savers credit or not. That could make a meaningful difference in your financial life. And that's where we say, well, work with your planner, because they can kind of do a pro forma and give you a sense for what kind of benefit you might have if you put those dollars in.
Yeah, absolutely. Let me piggyback on that, and then I'm going to insert the tax tip number 3 here really quick, and that is, folks, if you heard both Ryan and Kevin, Ryan said, hey, fund a retirement plan, maybe a Roth. Kevin said, fund your HSA. If you have the ability to do both, you should do both. If you can only do one, can I just throw out a fringe idea? Maybe you consider funding the HSA instead of the Roth. And we've talked about that on this show before. Now, your situation is unique to you, so that's not a final answer, but it's something you might want to consider, because you can pull that HSA money out tax-free, just like the Roth in retirement, if it's for medical expenses. But unlike the Roth, you got a tax benefit the day you contributed those dollars. So here's my third tax tip, and that is the opposite of what Kevin and Ryan were talking about funding. I'm talking about selling. Consider harvesting some capital gains. The stock market fairy has delivered a huge gift in 2017, at least so far. You may have a lot of appreciation in some of your stocks, and if you're in the 15% tax bracket, it might make sense to sell something to harvest some gains, because if you're in the 15% tax bracket or lower, those capital gains would be zero. You'd still have to pay state tax, but it'd be zero. So hopefully those tips helped you. Gosh, we could talk all day about that. But my guess is you're also curious, are you going to win? Are you going to lose with the tax Trump plan or the GOP tax plan? So we're going to hit all those details, those fun details, winners and losers, that and a lot more coming up here on Wise Money with Korhorn Financial Group.
Okay, dude.
That was good.
Listen.
Fun.
I have to tell 2 stories because I just had 2 of these situations. We just sold Mom's house. We just sold this piece of property that Dad gave us. So they came in all freaked out about what they're going to pay in taxes.
Yeah.
No, 3 of them. The power company just went eminent domain on me
This one,
and just bought a couple acres of farm ground.
November 18th. My folder's already in box. Yeah.
And so 3 different clients come in, all freaked out about what they're going to owe in taxes.
Dude, you could do a whole show on that.
I know. And that's what I told Kevin beforehand. And folks, if you're watching right now, once again, you know, we always have way more stuff prepared than we have time for.
Okay.
We're hitting
Hey,
a lot in the tax show.
We need to do that before the end of the year because there are people, to piggyback on what you said, there are people that should be selling things that they have a gain in. And because I'll always ask them very gently, so do you know what the tax rate is on that? That's a capital gain. You know what your tax rate will be? Yeah. And they're like, oh, it's going to be a ton of money. And you're like, well, here it is. You're in the 15% tax bracket, so your tax is 0. So, hey, Daniel, can you look at at Ryan? Because we have the profile, and so you can see us, but I think he's got that mic too far in front of his face.
In the video.
In the video?
Right now, yeah.
Yeah, so should he turn...
It's off to the side.
Should he turn it...
Straight on it.
Is it okay?
Yeah.
Okay.
It's
Cool.
angled a little bit, like, because when he has it off to the side, so when he talks straight ahead where it's not blocking him, it's still picking up the audio, okay.
Okay, because Jeff...
He sounds great.
When Jeff Bernier was on, he had the microphone here, and you couldn't see his
him.
face.
And folks, if you're watching online, so we've got producer Casey Hendrickson with us behind the video. If you want to see his video, you need to check out his show, Monday through Friday, 3 to 6. Yeah, but he's Facebook Living all of his shows now, so you need to watch it. The YouTube.
We do YouTube 4 days out of the week, and we do Facebook on Fridays when we're not doing remote.
Awesome. And then the other voice you heard was Daniel Davis, who's newer to the KFG team, a huge asset. He's doing technology and marketing, so he's going to be helping with the show as well. Probably won't see him much on the other side of the camera, but he's going to be helping out with the video and all of that. So,
I have a face for radio.
face for radio, we've all used that joke, Daniel. Sorry, but
I used that on Casey my first show.
That's true.
Okay, so do you want to touch on that and then get into
I would love
tax
to
plan?
just give a couple of quick stories, and then if you want to talk about the tax plan, I'm totally down with that.
Yes. And Ryan, you're going to lead that, and we'll all chime in. And
Got it.
All the new stuff in the Senate version today.
Well,
Yeah.
today I got something late last night.
We voted on it yesterday, and so we've got a comparison between the two.
I've got the comparison from the Wall Street Journal. I sent it over to Ryan last night.
What a stinking ripoff, man.
Mike Bernard, Kevin Korhorn, and CPA Ryan Fair in the KFG studios. We're so glad to have you with us. We're talking taxes today, folks, but it's exciting, and it's about to get even more exciting because it's getting political. Are you going to win? You're going to lose with the Trump tax plan. And we've got the side-by-side, and this stuff, folks, it's changing, and it's so politicized. Okay, so there's going to be tons of revisions and so on, but we're going to talk about the side-by-side, whether you might win, whether you might lose, and what it means for your planning here in just a bit. Special thanks to the attorneys at Ledoux, Kern, and Keene, as well as First State Bank for making the Wise Money Show possible. And if you've missed anything or have a question, want to remind you, call, text 574-222-2000. Visit us at wisemoneyradio.com. Check out Facebook, YouTube, or Twitter at Wise Money Radio. All right, let's pick the conversation back up. We gave you 3 tax tips to consider before year end. In fact, a couple of those you actually have until April 15 to fund. But the discussion that I left off with about capital gains stirred things up, Kevin. So before we jump into the GOP tax plan, let's elaborate a little bit on the capital gain issue.
Well, I think it's a big deal because I was just relating to you guys how I had 3 different clients come in, and one had sold mom's house, one had sold a piece of property.
Did mom know about it?
Yeah.
Okay.
Okay. Where'd my house go? And then one had sold a piece of property that dad had given to them, and one had dealt with eminent domain from one of the utility monopolies, and so they had land that they'd bought many moons ago that now they got an amount of money for that land. And so they all 3 came in dreading the conversation and almost didn't want to even tell me. But because we do tax planning and we were looking at this, and I said, well, listen, in each of these scenarios, it was a married couple. Taxable income wise, you can have $75,000 and change of taxable income on the federal side, and you're in the 15% tax bracket. Well, if you're in the 15% tax bracket, your capital gains rate is 0.
Yep.
And they were all worried about the basis and how am I going to figure out. And the folks that had sold mom's house came in with the list of all the things, all the expenses related to the house. And, you know, mom and dad had bought the house back in 1950. So, I mean, they were able to come up with about $20,000 worth of expenses all in on the house that they sold for $100.
Yeah.
And so there's gain. And so, so when I was able to show them, hey, listen, because of where you are in your tax bracket, your capital gains rate is 0.
Yeah, it's amazing. It's amazing. And folks, you need to be prepared because there still would be state and local taxes most likely.
Correct.
Right? But then also, it's a sliding scale, as Ryan would tell you. And so you can start tipping that scale by a couple other I don't know, unconscious action. I mean, unintended actions, and all of a sudden that scale starts tipping, and whammo, you've got taxes to pay. So be careful and do tax planning, folks, especially in those instances, like Kevin said, where you really don't want to admit because you think it's going to be tough. Listen, let's figure that out 5 months before the taxes are due so you can prepare for it and maybe even plan for it and reduce some of those taxes.
Yeah, and because our tax code is so simple, those capital gains could push some of your Social Security over for you to pay taxes on. Yeah. They could push you into a different bracket, and you could pay more for Medicare Part B. So there's all kinds of different traps out there that you want to be aware of. That's why you have to do tax planning.
Yeah, so you need to meet with Ryan or whoever your Ryan is. You need to call them and sit down with them before the end of the year. And really, your certified financial planner is the hub of that, folks. They need to be involved in that conversation. We're going to talk about tax mistakes in a little bit. That's one of them I'll tease out. All right, the simplicity of our tax plan is a great segue and an awful joke because we've got the House and the Senate are fighting it out right now about what form of a tax proposal they think they can get passed just to save their bacon. But truthfully, it's going to impact all of us. Are you going to win? Are you going to lose? And then to me, what gets me excited is whatever they come up with, what are the tax planning strategies that now emerge? So Ryan, in who knows what happened last night, right? But break down a little bit of some of what the plan entails and the differences and some of the high points.
All right, get ready. So this is round one, like Mike said. This is version 1 that they're releasing. First, the House Ways and Means Committee went ahead and released theirs, and then soon after, the Senate released their version of the tax plan. They have some similarities, lots of differences, and then that's where the negotiating and bribes and lobbyists all come into the picture.
Oh, yeah, lobbyists. That's the Washington D.C. word for bribe.
So anyways, let's start with the House version, what they passed or proposed with their first go round. So currently there's 7 different tax brackets and ranging all over the board from 10% up to 39.6, and the House is proposing to simplify that and go down to 4 tax brackets, which that by itself is a win in my book, at least for ease of planning. Lots of changes with itemized deductions, standard deduction, and exemptions. So with this House plan, they are proposing that the standard deduction goes way up. So, and actually the Senate did mirror this in their version when they released it. So both standard deductions are going basically double what they
Yeah.
are now. So the proposed 2018 standard deduction is going to go up to $24,400.
I don't know if
For
you're
a married
keeping
couple.
score, but that's very close to what Trump campaigned on, was doubling the standard deduction and then getting rid of the exemption, which both proposals do, right?
And the exemption is the coupon that you get just for being you.
I think that makes sense to add that to the standard deduction. But if you've got a lot of kids, and you guys know baby number 3 is on the way, you could start losing
Qualifies
here
for a lot.
because you get an exemption based on number of heads in your household, right? And
Yes.
if that's going away, if you've got a lot of kids, you got a big family, that could
So
hurt you.
Congress did think of you a little bit in that situation. So normally you get a child, or normally meaning currently, child tax credit's $1,000 per child that's under age 17. That's changing, and it's going up to $1,600 per child. So
If you qualify.
if you qualify, right? So that $600 extra that they're increasing the child tax credit for is basically 15%, or the current exemption times 15% tax bracket is kind of how that's justified. So the higher tax bracket will not benefit as much, but the lower will basically stay the same.
Yeah. The thing that I think is most important, and maybe not to all of you, but I know a lot of listeners to the program here own your own business. And the pass-through tax rate that both are proposing, it's a change to what it is right now. And why does that matter? If you own a small business, you know resources are tight. You're trying to deploy those resources in your team and in the capabilities of your team to provide for your customers. And a reduction in those in the tax that you pay on that pass-through would be very meaningful for small businesses and, I believe, our nation as a whole. So,
Yeah.
No
for sure.
argument here.
Yep. Basically, what they're doing is capping that business pass-through income. They're putting a cap on it so that it's not taxed all as ordinary income, but part of it is at a lower rate, which is good for small business. I want to jump back to the standard deduction, itemized deduction conversation real quick, because there's really a lot that comes out of that itemized deduction. So right now, lots of our clients itemize their deductions. So the normal itemized deductions, state and local income taxes that you pay, your property taxes on your houses, mortgage interest on, again, your up to 2 houses, charitable contributions, those all fall into the normal itemized deductions. And a lot of that stuff is changing. Medical expenses, the House is proposing that we get rid of the medical expense deduction.
I think there's going to be
Yeah.
a lot of debate on these itemized and which ones get cut, which ones get changed. I do want to hit those highlights. So we've got that, as well as what tax mistakes. We talked about tax tips. We're going to talk about tax mistakes you need to avoid this year as well. So that and more coming up here on Wise Money with Korhorn Financial Group. Yeah, we'll pick it back up, because
Yeah,
I think
that's
those
fine.
are.
Well, there's a bunch of them.
Well, you can talk about whichever. I think those, and who knows, in a week,
Right.
those will get debated and changed a lot. So if you at
Okay.
least touch on them, I think it's, what's being communicated.
Yep.
Oh, really?
Yep. They're leaving it in there.
Right. Well, whoever's oxen is being gored at the moment is really upset. It's a shamalama ding dong. They're talking about a doggone file this thing on a postcard, and all I see is more complexity.
Yeah.
Like, you you look at this, you're like,
Let's-
I'm not smart enough to do this.
Yeah.
It's ridiculous.
Start back
Right.
with that.
So we got
So-
the Yeah.
we'll do. We'll talk through this as long as we need to, and then we can switch over to tax mistakes, and we'll see. We're right on schedule. It's fine. Do you have?
No, I get so fed up with this stuff.
Share it, man. When you,
I'm triggered. I got my anger
That's
issues.
a part of it is people, okay, will this be simpler? Will this be easier?
No, there's nothing simpler about this. There is nothing that makes sense to me about baking into the tax code behavioral manipulation. So all these people are saying, well, I want credit for this and I want a deduction for this and I want no.
to argue the opposite, the one that I would argue with you on is retirement. I mean, we obviously, going back to those stats Ryan shared, which we've shared before, people obviously need some sort of nudge, encouragement, say, for retirement. And
Yeah.
I like that behavior manipulation. But the one about
But that's
mortgage
that's
interest,
really not behavior manipulation. All that's doing is saying, hey, listen, we're letting you keep your money,
yeah,
right?
yeah.
So
Yes.
if I can keep my money and I'm motivated to do that, come on, Shazam, I'm getting her done.
All right, we got a lot more to talk about here. It wouldn't hurt if it's a dynamic discussion. Wouldn't hurt my feelings if we're talking tax plan all this segment, and then we finish with tax mistakes. Wouldn't, but it's got to be a good
Okay.
conversation.
Because
Otherwise,
there's a lot of tax mistakes,
yes. All right.
unless you're a client of our firm, of course.
Are you concerned about the GOP tax plan and all this shenanigans, as Kevin was just talking about over the break? Gosh, we're talking about those details and the winners, the losers, all of that right here on Wise Money with Korhorn Financial Group. Mike Bernard, Kevin Korhorn, CPA Ryan Fair in the KFG studios. If you've missed anything so far, catch the show on YouTube. Just check it out, Wise Money Radio. You can also find us online, wisemoneyradio.com. All the episodes, not only are they on YouTube, but they're all podcasts as well. They're on the website. They're on iTunes, Google Play. You can check it out that way. You can submit a question right there online as well. Also call text 574-222-2000. Hey, just want to say thanks real quick to Bethel College Adult and Graduate Studies, as well as Diane Bennett with RE/MAX 100 for partnering with us on the Wise Money Show. Okay, had a very dynamic discussion over break, so check out the video online. But let's dive into it. Ryan, we left off with you talking about one of the things that's really heavily debated right now are what itemized deductions will stay, which ones will go, which ones will change. Just run through that list real quick.
Yeah, so in this first round of legislature that they're proposing, medical expense deduction is going away.
Get rid of it.
Get rid of it. That's what
Okay.
the House says. Senate, they came out with theirs and said, no, let's keep it.
Folks, get rid of it isn't heartless. They've changed it enough over the years. It's extremely hard to take advantage of because it doesn't apply to folks with really high income, and because of your health insurance, it really doesn't apply to most people at all. They've made it so difficult already. Get rid of it.
Yep.
Anyway.
So yeah, that's what the House said. Senate said keep it. State and local income tax deduction. This is a big one that gets a lot of debate. Basically, the House said get rid of it. Basically, that means your state and local taxes you're paying through your W-2s, gone. On the
Deducting those from your federal return.
deducting those. Yeah, you're still paying the taxes.
Yeah.
You're just not deducting it from your tax return. Mortgage interest is an interesting one. Right now, you can deduct your mortgage interest on your house up to $1 million of acquisition indebtedness. So basically, you can take out a mortgage on up to $1 million and deduct that interest from your tax returns. The House, their plan is to reduce that down to $500,000. So around here, that doesn't affect a lot of people. Larger cities, higher cost of living environments, obviously that's going to affect a lot of people.
Yeah.
One other thing related to the mortgage interest is they're proposing to get rid of the tax deduction for home equity interest.
I didn't hear that part.
Yeah.
Really?
Yeah. And so that was in the House, and I believe the Senate also came out and said the same thing. Get rid of home equity mortgage interest deduction. So that affects a lot of people.
It could be a wave of refinances then.
Yeah. Yep.
Right, because if you've got a mortgage and a home equity line, and one helps you on your
Consolidate
taxes
and
and one doesn't,
Yep.
you'd refinance. So
the-
keep your credit score strong, folks. Keep
Yep.
your debt to income strong. Keep your financial house in order, because you might be getting a tax benefit now that you won't get tomorrow, and you can change some things if you have good complexion, let's say.
Yeah, but here's the deal. If they take the standard deduction and jack it up for most folks,
not gonna matter for
Right,
most anyways.
it's not going to matter because you likely won't have enough mortgage interest, real estate taxes, state income taxes, et
If they get
cetera,
rid of
et
state
cetera.
income taxes,
Yeah, that's huge.
yeah, gosh.
So another related one, mortgage interest deduction is only going to be allowed on one home.
Oh,
So that affects a lot of people that have a second home or a cottage or vacation home, something like that. That's just a personal use property. Right now, you can deduct that mortgage interest on your tax returns.
sometimes even your RV as well, which
RV,
is
your
huge
boat.
around
As a
here.
second
You
home
can deduct the interest on your boat.
Yeah.
in some situations. Not all, Kevin. Not your
got your
pontoon or fishing boat.
Bass boat.
Yeah.
It's got a galley and a head. Okay.
Okay, property taxes. So those are still going to be deductible, but the House plan is suggesting that they cap it at $10,000 as the property tax deduction. So again, around here, not a big deal. Most of our property taxes locally don't approach that level, but there's clients that we have that have second homes in Florida, Arizona, California, those types of places that do have outrageous property taxes. And so they're going to cap them combined at 10,000. Another one that was interesting in the House plan, again, I guess this is to simplify the calculations, but miscellaneous itemized deductions for business expenses are going to be erased.
Really?
So all of our
Interesting.
clients that do, we call it Form 2106 for unreimbursed business expenses. This is for the employees that have out-of-pocket expenses for their employer. Common one is salespeople that are driving their own vehicle.
Yep.
They deduct those miles in this part of itemized deductions, and right now that part is proposed to be eliminated as part of the itemized deductions.
Okay, so you used the word simplify. Kevin went on a rant over break. Kevin, I'm going to ignite that fuse again.
Yeah, I can't even go there. So this is what I'll give you. If you're listening right now and you're wondering how should you be following all of this morass, what I would encourage you to do is do it like I do. Like I like to watch a Notre Dame football game. I have two different approaches to Notre Dame football, and I love Notre Dame football.
You're going to hurt some feelings here with that comparison.
No,
but
I'm
go
just
ahead.
telling you, if you do it like I do it, you'll be a happy person, a happier person. So I like to watch the first and part of the second quarter, fall asleep, and wake up with about 5 minutes left in the game. You watch the last 5 minutes, and it's as if you've watched the whole game, but you're energized, and now you're ready to go to your honey-do list. That's one way. Another way to do it, skip the game altogether and get up early Sunday morning and go get the South Bend Tribune, read about the whole game. You can talk intelligently about the game as if you watched the whole game if all you do is read the doggone highlights in the South Bend Tribune. And look at the amount of you just gained 4 hours. 4 hours of fun time. So here's the thing. Do not pay attention to this. It's all noise. It's all noise. You got the B team in the swamp putting together this monstrosity, and they're saying, well, it's going to simplify things. Hey, you can do your taxes on a postcard.
Here's
Are
your
you kidding me?
postcard.
Are you kidding me? They're making it more and more and more complicated. They're taking these levers that manipulate behavior. We still have an issue with 80-some% of the taxes paid being paid by about 10% of the population. So that, in my humble opinion, is a huge issue.
So that you start touching a different nerve there. I'm just talking about simplicity, folks.
Yeah, it's
I've been
complicated.
saying ever since they started campaigning on a flat tax rate. I personally am against adding it to the consumption tax because guess what? Then that would drive consumption down, which might help some people, but it would hurt the economy. Okay, but some sort of flat tax.
Well, and what
this
is not
not simple.
Yeah, and what's not coming out of this is I'm still waiting for the person to say, hey, we need to spend less.
Yeah.
And every household that's listening to this radio show has come up against this where they said, you know what, we're going to have to spend less money. I'm still waiting to hear that conversation come out of Washington, D.C.
Yeah.
So
You might be waiting a long time. All right, Ryan, is there one last item that you've got to hit? Or have you hit everything? You've got a long list there.
Something good. AMT's repealed. So
Thank
there's
goodness.
there's a simplification.
That is.
There
So
you go.
alternative minimum tax, which is an awful feeling for those of you that have had to pay it in the past. I love the fact that that'd be going away.
And then one other that's kind of a hot spot with the House. They said get rid of the adoption credit.
Yep,
Senate left it in there, but that's a hot spot that causes a lot of debate for people.
absolutely. Here's the deal, folks. As Kevin just mentioned, you can fall asleep right now. Turn this off, okay? Well, not the show, not the Wise Money show, but the debate about the taxes, okay? Turn it off and catch the ending and then plan for it. Folks, they're not making it more simple, and even if they did, there'd still be planning opportunities. The point is that whatever they change, whatever they adapt, you're going to want to be aware how that adaptation influences your tax strategy and your tax planning. Be proactive, whatever they come up with, folks. Make sure your certified financial planner is working with your tax preparer and you guys together, all three of you are doing tax planning. That's how you win. It's not whether the vote goes one way or the other. That's how you win. All right, we're going to talk about tax mistakes you need to make sure you avoid. That and more coming up here on Wise Money with Korhorn Financial Group. If Casey
Who is dumb
smiles.
enough to think that they were going to simplify the tax code? Raise your hand.
No, not
Those of you
me.
in the audience. Oh,
it's going to happen,
fell
Casey.
for it.
They're going to do it, Casey. I know they are.
You fell for it.
Listen,
He's trying to get rid of me.
Jackie Walorski represents me, Casey. She's going to do it. Fred Upton, he may have gotten rid of the light bulb, but he's going to get rid of this other stuff too, Casey. He's awesome.
Oh, my goodness.
Just lost 2 audience members.
Yeah.
Oh.
Still getting used to the fact that we're recording every show
Yep.
and that the banter on
yeah,
on
Casey.
break
Casey's over there needling. Blame Casey.
well, we haven't had
Jeez
one this
Louise.
energized.
I had lots of things to say in the last thing.
I know. I know we've got a good discussion going if I can peek over at Casey and he's smiling. So I saw that a little bit. So
I just enjoy watching people all of a sudden kind of realize what
yep.
I've been telling
What
them.
you've been saying.
I mean, you guys, and the financial bit of it, you guys were already there, but I enjoy watching it actually happen out there.
Yes.
Well, yeah, and so for those of you watching, you can watch us 1 hour a week, or you got 15 hours of Casey.
That's right.
We're taking all of his wisdom, distilling it down into one short hour. Okay.
All right, so let's we're laying on the plane. We're going to talk about tax mistakes. I've got several. Ryan probably has several. I'm assuming we'll have a dynamic conversation. Won't be able to say all of them, and then we'll land it.
Okay.
Okay.
So much winning.
What's that?
So much winning.
Yes, so much winning. Yeah. Golly. All right. Mike Bernard, Kevin Korhorn, special guest CPA Ryan Fair coming to you from the KFG studios. This is Wise Money with Korhorn Financial Group. We've been talking taxes today, folks, and it's been exciting. We were just talking about who's winning, who's losing, and it feels like we're all losing with this tax proposal and whatever they come up with here. If you've missed anything, you can catch up on the show in a couple ways. Every show's podcast, so you can find us on iTunes and Google Play. It's also on the website, wisemoneyradio.com, as well as YouTube. We've got the YouTube channel lined up. We've been rolling for most of the third season here is in YouTube. Just check it out at Wise Money Radio. Okay, we started with some tax strategies that you need to consider employing before the end of the year. We gave an update on the shenanigans in Washington, D.C. on their tax plan. Now, what tax mistakes do you need to make sure you avoid? Sounds like one of them we already hit is paying too close of attention to the political tax debate and starting to think, well, this for sure is going to happen or that for sure is going to happen. But let's get a little bit more real, Ryan. What's a tax mistake people need to watch out for?
Yeah, so some of the stuff that I see, in a lot of these are mistakes in the client's favor when they are when I see self-prepared returns come in. So I just get a little chuckle out of those, and then have to talk to the clients about fixing them, and
then they
stuff.
hate you.
Yeah, they hate me. A lot of clients when I see the self-prepared returns, the TurboTax, the online free file stuff, clients just don't understand a lot of stuff.
It's complicated.
Yeah, it's complicated.
Yes.
And they deal with it once a year, where we deal with it every day. So it kind of gives me a chuckle, but it's not funny when you're the client on the other end of the table. So double deducting a lot of the expenses that are paid through payroll deduction. So I see that a lot, where clients will contribute to their HSA through payroll, and then when they get to that line of the tax return that they're working on, they see the line 25 or whatever it is for HSA deductions, and they say, "Oh yeah, I put $2,000 in my HSA. I'm going to put it on that line." It's already due through payroll, which means it's already pre-tax.
Can I point one other? Brad from Mishawaka, he's age 40, reached out with a question and said his employer offers an HSA and they contribute $750 to it. Does that influence how much he gets to contribute? And that's another mistake, Ryan. So can you just touch to that, speaking of this mistake? If your company, if the employer is contributing to your HSA, that actually counts towards the overall contribution limit. Is that right?
Yeah, I believe so. The contribution limits are the max, regardless of how the money gets in there.
Yeah.
They're the maximum for 2017, $3,400 for self-only coverage, and $6,750 for family coverage.
And if your employer is contributing, that counts towards that. This is different than how 401ks or your 403b match is. That their company match for your retirement plan does not count towards those limit, but the HSA it does. So yeah, that is, I see that mistake often, Ryan, as well, when new clients come in, and that's a great question, Brad. What other mistakes do you see there?
Yes, the college credits are confusing. And so a lot of people, I see clients mess those up pretty frequently.
Give an example or a warning here.
Yeah, so an example would be probably just either miscalculating the credits or not using the right credit, whether they, again, if they're looking at the front page of the tax return where they see tuition and fees deduction, they might just assume, oh, that's where I need to put my college costs in, and not even see the credit on the next line, which the credit is obviously more beneficial. But I've seen that a few times recently, and just knowing which expenses do count towards the education credits, I see that problem a lot. Just the confusion of knowing what is and isn't covered by the credit.
Yeah. I've seen, just to piggyback on the college issue, I've seen mistakes that you don't want to make, these folks, contributing to the wrong 529 plan and expecting to get, or even listing that you get the credit. If you live in Indiana and pay Indiana state tax, you've got to use the Indiana College Choice 529 plan in order to get that tax credit. The other is each 529 has one owner, has a successor owner, and then one beneficiary, which is the student. If you're pulling money out of that for college, it's got to be for the student listed on that plan. If you've got 2 kids or 3, then, and you've got a couple in college, you've got to take the money out of the right child's plan and use it for that child. Otherwise, it's a non-qualified distribution, penalized and taxed.
Yep. And Indiana does check that that 529 credit as well. So don't think that you can try to sneak one past the Department of Revenue. You'll get a letter in the mail sooner or later, because they do coordinate with the College Choice 529 and match up account numbers and contribution amounts. And
be watchful for financial advisors, so-called, who are selling products. because I see and hear a lot of advertisements for this type of 529 plan. It's got these features and so on. Folks, you want the one that gives you the state tax credit. There is no feature that's going to be better than that. And so don't be convinced from some advertisers or other folks that a different 529 plan might be the best idea. No, your state, quote unquote, endorses one, uses one. That's the only one you get the tax credit on.
And the nice thing is in Indiana, it's a good plan. If you're in Michigan, it's a good plan. That's a deduction.
Yep.
But yeah, make sure if you live in that state and pay taxes in that state, you're using that state's 529 plan.
My biggest mistake that I see folks make is not being proactive and therefore not being aware that their adjusted gross income all of a sudden just went up just a little bit. And now they've entered something called a phase out for whatever it is. We're talking about college. The phase out for some of the college credits, all of a sudden you get a bonus, and that feels great. It's a $5,000 bonus, and all of a sudden that moves your adjusted gross income from 160 or 159 up to 164, and all of a sudden some of those tax goodies that you got because your child was in college start going away, or the child tax credit start going away. These are things, folks, you need to be proactive on, and that, if your financial house is in order, you can get upset at the government that they put this phase out in there, or you can look into, all right, what can I do to make sure it's still there and still make as much money as possible? Save more to your 401k, use your HSA, use a flexible spending account. You got some levers there that you can pull to make sure you stay below that phase out as long as possible. That's the biggest mistake I see.
I mean, thinking of a phase out, I just met with a guy, and he's commission, so he basically eats what he kills. And this year has been a good year, but he's been working with an investment salesperson, which is different than a financial planner. Certainly a certified financial planner. His investment salesperson has him doing some of the right things, saving monthly into a Roth IRA, which is great, except his income this year exceeds the limit. And he didn't realize there was a limit. So he's put money once a month into a Roth IRA that he's not able to do. So he's going to be, at tax time, if he catches it, he's going to be backing it out. And if he doesn't catch it then, like Ryan was talking about, the dreaded letter that you get after you send in the first offer to the IRS and the Indiana Department of Revenue, and they come back with a counteroffer, it's no fun. And no one feels happy about that. The mistake that I was looking at, though, thanks for asking, Mike, is you said not being proactive, and that's exactly it. And that has to do with your estimated tax payments, because it used to be in 2007 there was about 7.5 million people that were penalized for underpayment. In 2016 it's up to 10 million. So there certainly are teeth in this deal, and about 80% of U.S. taxpayers pay taxes through payroll, but there's about 20% of non-wage earners have to estimate, because the government wants the money to come in as you've earned it or as you've received it. And if that's not happening, you can end up with a pretty gnarly underpayment penalty.
If it's not happening and if you're not doing it right, there's some specific rules with that. So there again, making sure that your certified financial planner is working with your tax preparer and you to develop a good plan to stay on top of your taxes, folks. So, Ryan, thank you for being with us. Ryan is a regular contributor to the Wise Money Show, so that won't be the last time you hear him. On behalf of Ryan Fair, Kevin Korhorn, and myself, and all of us at Korhorn Financial Group, have a great weekend, folks. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.